Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Paul from the Sirius Report. Hi, Paul. How are you?
Yes, I'm very well, Mario, and yourself?
I'm well as well, and we haven't spoken in a while. And in our pre-interview chat, we were talking about how there's so much going on, but we will focus though on a few points today. The first one I wanted to bring up is the question of the banking sector, especially in the U.S., and how do you think it could spill over into the rest of the world?
Well, I mean, let's not go through the entire history of what's happened in recent months because a lot of it's, is now sort of anecdotal data, but it obviously became apparent, and we've spoken about this previously, that once you start to raise interest rates in an environment where you have endless QE zero interest rate policy, eventually it's going to blow things up, especially when the entire, not just the US, is predicated on endless cheap credit. There's an inevitability that at some point those assets on banks' balance sheets, which a lot of them relate to the fact they have bond holdings, they were going to become not crystallized losses, but have enormous paper losses. And at some point, there was always the risk that there might be a run on bank deposits. And when that happens, then suddenly there's this mismatch between liabilities and assets. And then you get the fire sale and with subsequently enormous losses potentially being crystallized. And then it's big, then it's a serious problem for banks. And it's not a too big to fail problem per se, but I mean, I'm not saying the too big to fail banks are immune from a similar scenario, because in reality, you notice a lot of the language coming out at the moment is all about defending asset prices, meaning we have to defend the asset bubbles we've created since 2008, because if those asset bubbles disappear, then all of a sudden we're going to have enormous asset impairment, and it won't just be the sort of mid-tier regional banks that have a problem. Then it can potentially spread to too big to fail banks. So in essence, they have to try and create the illusion that there isn't a problem with asset prices. But we know in reality that that is now starting to become more and more of a problem. And we've highlighted the issue of why, if you bought bonds, I don't know, 12, 18 months ago, obviously not short-term bonds because they mature within that period, but if you bought long-dated bonds, you're going to be underwater significantly. And therefore, this is back to this issue of, well, when do you crystallize those losses? Or when, and there's all sorts of ludicrous ways that banks' balance sheet don't reflect the reality that, you have impaired assets. Okay, you may not have had to realize those losses, but the moment you do, you're in serious trouble. And of course, back in March, as we know, when it's an ongoing process, the Fed had to intervene, and the US financial regulators. So they effectively, in inverted commas, all these commercial banks borrowed 500 billion in a matter of 2 weeks, and the Federal Home Loan Bank system, in the sort of middle to the back end of March, in 1 week alone, issued over 300 billion in debt. Now, when you put that in context, it took 12 months during the so-called global financial crisis to reach 350 billion. So that gives you an indication of the severity of the problem.
Paul, you know how important it is to have some gold and silver as insurance. So with that, I wanted to give a shout out to Gold Investments. They've been in business for 42 years. They're arguably one of the oldest family-run bullion dealers in the city of London. If you're looking to buy gold and silver, make sure you check out the details below in the description.
And of course, there's all the discount window lending, and then they came out with this new vehicle called the Bank Term Funding Program, which was supposed to provide loans to banks, credit unions, and other financial institutions, apparently for up to a year, on these very highly favorable terms in exchange for treasuries that were, and then we're going, but actually, even though they're underwater, we'll give you them at par value. I mean, and this just makes a mockery of the entire treasury market and the US financial system. So that's one aspect in very broad terms what's going on. We also saw the issue where deposits in banks have been falling. This is, everybody knows about this, and the question is, where's the money going? Because the argument is it appears to be notionally disappearing out the entire financial system. And so the question is, well, and everyone thought, well, it must be money market funds. So the intention of that is there these so-called, dare I use the word, low-risk investment vehicles where people park money in. Note again, short-term government debt and corporate debt. And when SVB failed, effectively there was big inflows. To put this in context, I'm not sure what it is now, it's probably increased, but I think probably a month or two ago, it was at around 5.4 trillion of assets in money market funds. Now, there's the whole issue of money market funds and its shadow banking, and I have extreme reservations about money market funds. And also, you're buying short-term government debt. Well, what happens if you bought short-term government debt? And we know that there's enormous dumping going on because the yields rise sharply. So what happens on the basis of the short-term government debt? And you're suddenly underwater significantly as well. So, okay, we can't quantify that precisely. The other issue with money market funds was there was this idea that, well, the Fed's reverse repo facility was sucking all this money in. Well, if you look, from my perspective, since January of this year, the reverse repo has been pretty static at around 2.1, 2.2 trillion. I think it's probably 2.1, 2.2 trillion on a daily basis. So I don't see sudden big spike of money being put into the Fed's money market fund effectively, which is their reverse repo facility. So that then starts to make me think, okay, I'm not saying there isn't money at all going into money market fund, but I've long since had the opinion that I think a lot of the deposits leaving banks relates to foreign investors. And this not only ties in with a lack of confidence in the US banking system, but also it relates back to the whole thing we've said before about de-dollarization, about a lack of confidence internationally in US Treasury markets, and because of the idea, well, you could sanction us, you could sanction our central bank, you could sanction our banks, you might freeze our assets, so why would we want to leave deposits in US banks? And what I do know most certainly is, again, I can't quantify it in actual terms, but significant amounts of deposits have left the US and gone back to the Middle East and to Asia, and China being one of those examples. So this is an ongoing problem. Of course, once you start to have concerns about the banks, then there's always a risk you can have a so-called run on bank deposits just by virtue of the fact that it becomes a self-fulfilling prophecy. We know that to be the case, and I think there is an element where that is most certainly being a problem. And, therefore, on that basis, you could create a situation where, in reality, a bank doesn't have a problem, but suddenly if you start or notionally doesn't have a problem, but if you start removing deposits, and then also the other risk is that banks have certainly been shorted. I know there's this idea we should ban short selling of banks. I find that a bit ironic and a bit hypocritical, but beneath the sort of broad headline, there is some basis to say, well, for some banks, they've definitely been heavily shorted, and this has caused enormous problems in that then that creates this catalyst for people to want to withdraw their deposits because they think, that this bank's in trouble. Another point I think worth making is that all these unrealized losses in the banking system. Now, back end of 2022, it was supposed to be about 1.75 trillion. Now, if you put that in context, the losses were nearly equal to banks' total equity, in inverted commas, of 2.1 trillion. So that puts it in context. Now, okay, unrealized losses, fine, but how quickly could those losses become realized? And then there's all the contagion effects, systemic problems. I mean, there's no doubt, of course, that rising, should I say, interest rates have slashed the value, as we know, of US Treasuries and mortgage-backed securities, and that, unfortunately, makes up a large proportion of many banks' assets. I mean, so US bank assets have clearly lost what X percent? Is it 10, 15% of their total value? And the other problem is within the banking system, we still haven't reconciled this, is if you look at the total US bank deposits of about 17 trillion, probably somewhere around 7 trillion are not insured by the FDIC. Now, there's this big argument, are we going to insure all deposits, or are we just doing it on a sort of ad hoc basis, depending on what the institution is? But of course, if you don't insure depositors, then the risk is high net worth individuals are going to move their money out of the bank and put it somewhere else. I think the argument moving it out of the bank and putting it in a money market fund, for me, is not the answer either, but each to their own. And of course, we're back to that point. To what extent do they actually do this? I mean, and of course, the other problem is all these unrealized losses aren't reflected on bank balance sheets because of this accounting practice, which I think should be scrapped. But anyway, that's my opinion, where assets are held on a bank's book at the value at which they're bought instead of the current market value. Now, that's not strictly true across the board, but by and large, that is the case. It creates this illusion of a healthy balance sheet. And, you know, I also think it's a point worth making, and I tweeted this way back, that the idea that, you know, that somehow you can have a situation where, because a financial institution is profitable, it makes it solvent, it's a going concern, and nothing can be further from the truth, because it's always about leverage. I think the ongoing lack of risk management and the true extent of impairment of assets is certainly something that there is not enough thought given in that regard. So now you've got regulators suddenly deciding it's a problem where it should have been obvious. Raising interest rates was a huge problem. So you've got the EU sort of making noises, and the Fed making noises, and global regulators going, oh, you know, we need to do something about this. But if we try to do this, we won't get a uniform response to it. And how long is this going to take? And you know, by then, the entire financial system could blow up before we actually decided to make any decisions. And ultimately, they won't make any decisions that impact the banking or financial system, because they never do. And we've seen this, you know, all these promises since 2008, in reality, nothing's changed. So, you know, you can overhaul liquidity coverage ratios, for example. That requires banks to hold more high liquid or high quality liquid assets. But again, what is a high quality liquid asset anymore? Because treasury markets are illiquid. They're not high quality. And also, it's very clear that the world views the US Treasury market very differently than it did even a year or 2 or 3 ago. So it's all well and good going, we're going to change oversight of banks. You know, I'm saying that regulators need to bring capital and liquidity thresholds closer to what the large banks are. But if you do that, the banks will just fail stress tests immediately. Now, that doesn't mean that per se shouldn't happen, but you can't create an environment where you suddenly decide to put these onerous rules on capital and liquidity thresholds and then not expect it to be a problem. So this is in a broad sense where we are. There is huge vulnerabilities, of course, in the banking system because of asset impairment. This all relates to asset prices, and it's not just bonds. It's the everything asset prices. So you can go into the realms of commercial real estate, which is a huge problem. There's retail real estate. There's equities. There's the whole issue of not just sovereign bonds, but then you've got commercial bonds and the risk of the downgrading of companies from investment grade to junk status, so-called fallen angels. And So there are all these problems. And the question is, well, what's the issue with asset impairment? How about the liabilities? Is that increasingly going to be a problem? So the idea this has gone away is a nonsense. And we keep seeing very quietly the issue of, well, suddenly banks are at this window or that window, desperately trying to get a loan in inverted commas. But if we go back not that long ago, within the last month or so, maybe a little bit longer, there's been lots of reports that way in excess of 150 banks have the same kind of risks as the ones that have failed. There is certainly way over 100 banks who are asking the FDIC for insurance on all their deposits for at least the next 2 years. That this far hasn't happened. So most certainly there's a realization, at least at some level, that this isn't the problem the Fed keeps trying to tell us has gone away and everyone else. And 1 minute, the banks and the financial system sound and resilient. Well, it absolutely isn't, because if you pulled all the vehicles that prop everything up, it would collapse in the blink of an eye, as we rightly know. And then we come to the issue of all the problems that raising interest rates are, and how it's notionally we're now in that phase of everyone's worrying about a credit crunch, and so to speak, those words are being uttered again. And there are a lot of factors in terms of that, which is like lending contractions, one example of it. We know there's the issue of the shrinkage of the money supply, which is M2's now at the fastest pace since 1960. And obviously there's issues with funding, there's issues about access to credit markets, and the fact that credit spreads are rising. And it all largely relates to the fact that, if you have a spike in interest rates, then money's is exiting the banking system. It shrinks the availability of loans. Okay. I'm not the biggest fan of giving everyone loans, but if that's how the economy works, then you're going to start to cause enormous problems in the economy. So do we get into the realms? Is this a crash? Is this people talking about deflation? Is it stagflation? Because we still have persistent, sticky inflation, so to speak. And then, what's happening now with, we talk about banks and impairments, they're going to have to write off bad debt, and they're going to have to set aside additional reserves because of all the macroeconomic conditions, obviously getting worse. And it's interesting when you look at what's happening in terms of provisions on bad consumer loans. These are back to levels we saw at the start of the pandemic. Now, okay, people will go, so what? But we've basically gone back to there. And that doesn't mean it's not going to get significantly worse. So when you look at credit card losses in certain banks, they're making provision and they're increasing it by 50, 100, 200% from a year earlier. So, these arising provisions are going back to those kind of sort of on the cusp of when the pandemic started, and when they bailed everything out. So nothing's changed. We're back to that scenario. So, and then commercial real estate's a big problem since the pandemic, because loads of offices are empty. And so property valuations are falling, and this starts to cause issues in terms of the lenders associated with that, and the lenders that are the biggest credit provider in terms of real estate just happens to be regional banks. So this is in terms of offices, industrial, retail, hotels, apartments, etc. They are the biggest credit providers. So they can get underwater in terms of the fact, by consequence, that they made these loans, and now we're starting to see this contraction in credit, and therefore the assets that they've effectively have investments in are starting to risk impairment. We're seeing this increase in bankruptcies. So default rates are going through the roof. So, it's this kind of vicious circle that is creating this environment.
Yeah, and just to, one comment is you spoke earlier about that asset bubbles have to be maintained. And even though we've seen, like last year, the worst year in many decades for stocks and bonds. We're still highly elevated. I mean, the Dow is near 34,000. NASDAQ is still really high. The interest rates, bond yields are still, I know they've gone up a lot since 2021, but here in the UK, for example, we've got 10% plus inflation, and the whole yield curve is almost all below 4% in gilts. The US curve, yes, it's heavily inverted. And it seems to me that the bond markets are misjudging inflation. They expect things to go back to normal. And if you compare that to 1929, when there was a huge deflation after the crash of the stock market in 29 and 32, there was real pain. It doesn't seem like we have that much pain today. And I think it's all because the central banks have shown, like the Bank of England last year and the Fed this year, that if things get pretty bad and threaten this asset bubble you talked about, that they're going to intervene. And that's why I don't see inflation going away. Do you agree with that? And after you answer that, could we move on to the debt ceiling and see what's going on there?
No, I totally agree with you. I don't see. I mean, sticky inflation, core inflation is not going away. I mean, we know the inflation figures are totally manipulated, but at the end of the day, Western central banks have to create the illusion that there isn't a problem. Even when there is a myriad of serious problems we're seeing economically, financially, and the geopolitical element of de-dollarization, which most people are still living in denial it's happening. So yeah, I totally agree, but it's just manipulating sentiment. But you can keep manipulating sentiment to the point where in the end, that sentiment disappears. And the basic bottom line is you can convince people in the West and try to keep the illusion going. But if the rest of the world, the so-called global South, doesn't want to play ball with you anymore, then you're going to have enormous problems. You have to have the world in sync with what you're trying to do, and the world's increasingly not in sync. And the other thing is, of course, is because of these mid-tier banks, just a small point, they're the critical drivers of credit growth. I mean, if you look at it, banks smaller than the so-called top 25 largest accounts in the US, they account for nearly 40% of all outstanding loans, and they account for 67% of commercial real estate loans. So when you look at this, if you're you're putting in a situation where, because of this illusion you're trying to maintain, you're crushing these mid-tier banks, then it's going to have a knock-on effect in the real economy. And they can sit there and pontificate about how the Dow is at 35,000, and there isn't really a problem with the bond markets. But then, if the real economy craters to the point where it doesn't matter what they say, reality is playing out. Reality is playing out. And we're starting to see structural problems in mortgage markets, in credit markets. I mean, I only tweeted today that if you look at US total debt, it increased by 150 billion in Q1. This is household debt, by the way, to just over 17 trillion. And this is because everybody's now having to resort to paying because of the cost of living crisis with credit. I mean, this is not sustainable. So they can create all these illusions, the financialization of reality, which is just not reality. And the real world where true economics plays out, what's going to happen to business. I mean, we're increasingly seeing Chapter 11 bankruptcies in the US. So this is where reality plays out. So good luck to them convincing the world with all this bogus financial metrics, where in the real world we're seeing what's playing out, whereby this is completely unsustainable, as we've known for a long time. And that's why you can create the illusion of and give everyone the impression that US unemployment's at the lowest level it's ever been. Well, go and look at the fact that 90 million plus Americans are economically inactive, and how they rig job market data, how they rig the unemployment data and put people in categories. So actually, you're not unemployed anymore, even though you are. So they'll keep doing this until the point when the reality completely consumes them. And I think we're now at the point where we're seeing that
Yeah.
reality is starting to consume the illusion in a way it's going to be very hard for them to hide it.
I think one of the symptoms that this is an illusion of a healthy economy is the fact that the US and even the UK, we're running huge budget deficits. So maybe with that, we could move on to the debt ceiling, because if the economy was so great, the government would be running surpluses and paying off the debt, right?
Exactly, yeah. And we've seen the Congressional Budget Office come out and state they think the budget deficit for 2023 in the US will be 1.5 trillion. And I've seen projections going forward for the next decade and longer going, it'll at least be 1 trillion every year going forward. And which probably means it's going to be at least 2 trillion by the time we get to, well, as things stand, okay, things change because of all the impending problems economically, financially. But let's project it on the basis of where we are today. It could be 2 trillion in 2025. And I'm not exaggerating. So the debt ceiling, it's the usual kabuki theater. It's all politicians kind of trying to score points and take it to the wire. And I mean, the question is, will they agree something? In all likelihood, of course, they'll have to agree something. But this is, again, just the Republicans go, well, what? How can we score some political points? What damage can we do to the credibility of the Democrats, even though, of course, the political system's an illusion in itself. But in the process, you can do all this. But this is causing enormous damage to US credibility because the rest of the world's going, hang on. We know ultimately you'll either suspend the debt ceiling or you're just going to raise it. And you just have this flippant regard for US debt. We know you're printing money all the time. But in the meantime, you're desperate to get foreign investors to buy US treasuries. I mean, and then you're manipulating treasury markets, etc. But the truth of the matter is, the US government has to pay its debt, its bills, and the argument is, the US Treasury has to issue US bonds to pay all its obligations, and those obligations are growing. Social security, public sector, you've got military, retiree benefits, interest on national debt, which is spiking, tax refunds, the food stamps, the whole kind of way of supporting the welfare system, amongst other things. And what we're seeing on the flip side, because in the real economy, there's less tax revenue, higher spending, hence growing deficits. And they've introduced in January these so-called extraordinary measures, meaning we're just fudging our way to try and avoid this debt ceiling problem. So debt issuance is suspended to pay bills. The idea is Congress will make a decision, and they're not. But current national debt is ceilings 31.4 trillion. But if you look in the last 22 years, we've seen an average annual deficit of around 1 trillion per year. It's interesting, if you look at tax receipts, they were over 100 billion lower in 2023. And of course, the so-called US rainy day fund, the Treasury General Account, is being run into the ground relatively. I mean, if you go back to sort of the start of the pandemic, it was about 1.75 trillion. I think it's now somewhere in the order of about 250 billion. And so, of course, this is just all this fudging. And the question is, Yellen's keeps going, oh, 1 minute it was, we're going to run out of money September or August, then it was July, now it could run out in early June. Actually, do you know what? It might even be in the next week or two. There is no plan in place. Okay, they haven't got long to try and make a decision. But again, I think it is all kabuki theatre. But the question is what are they going to do? And if they don't do something, this is going to have not just an issue of credibility for the United States, but it's going to have ripple effects in small, medium-sized businesses, because it's going to make access to credit more difficult. It's going to cause huge problems for individuals and businesses because of this ongoing banking crisis. So this is where these two things are intertwined. I mean, and so, because there is huge amounts of small, medium businesses that are waiting for their employment retention credit, meaning a tax credit introduced to encourage employers, to retain their employees. Now, again, it's just fudging the system. And so therefore, this has been an issue where these fudge factors we've had since 2020 of what's largely kept small, medium-sized businesses going in significant amounts of money. And if the US doesn't have this in place, how quickly are these businesses going to go to the wall? It won't be, is it an avalanche effect? I mean, and how does it obviously affect this crisis amongst regional banks? This is a big problem because everything's interconnected. And if businesses don't get access to credit, and there is a problem with tax refunds and all this retention credit, then you're going to have a huge problem. And so there is no actual solution to this, of course, except you're going to have to raise the debt ceiling, or you're just going to have to suspend it and carry on, because you're also going to have problems if you do have a default. What's going to happen to borrowing costs? Credit cards, loans, mortgage rates, there's going to be a big spike. I mean, and therefore, global investors are also looking at this going, hang on a minute. We don't really, not all in, but essentially there's been no net foreign buyers of US treasuries for nearly a decade. They're going to be looking at this going, forget it. We're not touching US treasury market. It doesn't matter whether you raise the yields to infinity. We're not touching it. And the risk, of course, is if you have to suspend all payments, then there's going to be enormous amounts of layoffs related directly to the government or public sector, as well as private sector. There's touted millions of jobs could be wiped out very quickly. Relatively quickly if there was some protracted default. And what does that mean? Is it 8 million, 10 million, 12 million? Who knows? But they're up against the wall, and there seems to be, whereas previously everyone goes, yeah, okay, we know the last minute can do something, but there's a lot of it, certainly from the perspective I've seen and people I've talked to, where people are just going, well, this is not just anymore a question of, well, the ninth hour, they'll agree to something. There's just a total lack of confidence in the system. There's a lack of perception of credibility. I mean, I don't know why anyone thought there was credibility, be it in the Beltway, be it in the US Fed, but all this uncertainty is creating huge problems. And then there was also this idea that they were going to have this student loan for debt forgiveness. Well, I think that's not going to happen there. So, and student payments are going to, or debt, their interest payments or the repayments of that student debt is supposed to kick in. And a lot of these provisions that were made around the pandemic are all going to expire at precisely the wrong point in time. But so, of course, I mean, Yellen made the point it would be catastrophic if you don't raise the debt ceiling, the US would run out of cash. And therefore, it would be hugely detrimental because, I mean, what do they do? Slash spending. So notionally, the Congressional Budget Office goes to the deficit 1.5 trillion. You suddenly go, sorry, you're going to have to slash your spending by 750 billion. I mean, it's just, what's it going to do? And what's the catalytic effect of that? And how does that spread, not just from the economy and what it does, but then how does it start to hit these regional banks? And therefore, it just becomes this self-fulfilling prophecy where it's not a question anymore. What's the impact on we might have a bit of a problem with government spending for a while. Okay, we might have to slash some spending on a temporary basis until we find a solution. We could suddenly, if they don't put something in place, have a serious problem very quickly, which ties in not just economically but financially, and how that could affect these mid-tier banks.
Yeah, it looks from what you've told me today, Paul, that, and I'm not surprised, of course, that we're really between a rock and a hard place, not just in the US, but in the West. And that even though the Fed and the Fed officials talk tough on inflation. I think when push comes to shove, that balance sheet of the Fed is probably going to go towards 20 trillion very soon. And if it doesn't, then we could see a major collapse of everything, and that wouldn't be good either. So maybe to wrap up, maybe give us your opinion on what could happen for the Fed and the Bank of England and the ECB to maybe extricate themselves from between the rock and the hard place.
Well, in reality, there isn't a way out of this. I mean, it's the biggest problem is, and we've made this point many times, we've discussed it together here, and I've mentioned it elsewhere, and more times than I care to remember on podcasts, that if you had QE zero interest rate policy for more than a few months, 2 or 3 months, and it was to deal with the shock, that you get over the shock and then things return to normal. But because they've kept it in place for 14 years, effectively, to all intents and purposes, you cannot then be in a situation where you can ever raise interest rates again without bailing everything out, fudging everything, trying to pretend there isn't a problem when there is a problem. And I mean, we haven't even touched on the fact of the too big to fails and what's happening to their derivatives portfolios in terms of interest rate swaps, for example. I mean, they should have long since all blown up. So what chicanery is going on there, we don't know. But in a broader sense, going back to the point, if you create this environment, and then in the process, what did we do? We just created these enormous asset bubbles, which means these assets are so massively overpriced compared to reality. And at some point, those assets have to burst, and they just keep trying to prop asset prices up, because once asset prices have gone, I mean, if we actually allowed them to deflate, or they burst to, and go back to their true mean, what would that do? Not just in terms of people's pensions, people's their savings or their equity. It would just blow the entire financial system up, because you would have asset impairment on steroids. And it wouldn't just be the mid-tier banks, it would be the too big to fail. Everything would effectively, if you looked at, I mean, what would the asset valuation be? They may have, let's just not pick on a bank, but let's just pluck a nice tidy figure out, 1 trillion of assets. If those assets actually were at the true value, which might be 20% of that, they're underwater for 800 billion. Now that could be one institution. Multiply that by all those institutions, and then there's all the contagion effect, and the whole thing would blow up. So they have to keep this illusion going of we have to preserve asset prices whilst raising interest rates in an environment where those asset bubbles cannot be sustained. And those interest rates, and it's all predicated on the fact that the Fed sat there going, but we have to tame inflation. Even though they don't understand what's causing the inflation, they don't understand the sort of core inflation, and also because inflationary measure is a complete work of fiction like everything else. So the issue comes about then that, okay, what do they do? I mean, okay, credibility is one thing, but I mean, who cares about credibility? Credibility doesn't solve a crisis or prevent a crisis or actually create a sustainable monetary environment and create a sustainable fiscal environment and economy. It's just words. But okay, the issue is if they keep interest rates high, they're just going to blow everything up. But we've always made the point that if they start slashing interest rates, the argument is they're going to create not so much the sticking, but they're going to create more and more inflation. So either way, if they blow everything up by keeping interest rates high, they're going to have to print, who knows? I mean, as you make the point, Fed balance sheet, does it go up? Does it double? Does it treble? I mean, just printing in ridiculous amounts of money just to stop everything blowing up. But in fact, everything will have blown up. So economic reality will prove that. Or do they do the flip side and go, well, we'll just have to slash interest rates again? And then we start to have huge inflationary problem over and above what we already have. And then what do they do then? They just blow everything up because of inflation. So it's what happens if you allow QE zero interest rate policy the way they did. And that's why I wrote to a number of, including the Fed, including the ECB and the Bank of England, went, if you implement QE zero interest rate policy for more than a few months, it's game over. At some point, you will blow everything up and it'd be the end. It'd be the end of the Western financial system. It will be the end of it. And of course, no one replied. Probably nobody read it, or if they did, they had a laugh and thought I was talking nonsense and threw it in the bin. But it's always going to happen, and we are at that position now. So it doesn't matter whether the Fed flips and all this idea, or the Fed's going to pause, or they're going to lower interest rates. There's still this idea in many people's minds that we can normalize things. We can normalize asset prices. We can raise interest rates and not blow the real economy. And bearing in mind that everything's predicated on that. If you didn't have credit, the entire economy would collapse. I mean, and we're seeing it now with this cost of living crisis, where they're still coming out with this nonsense that, well, everyone's spending all the savings they accrued during the pandemic. If that were true, why is borrowing going through the roof? Because it isn't. People are borrowing to stop the wolf coming to the door. I mean, and in that scenario, that if interest rates stay high, then that problem isn't going to go away. It's just going to get worse. And of course, this affects people's employment, and the risk is they'll lose their jobs, and they're not going to be able to sustain a cost of living crisis when they don't have a job. I mean, so these are all very obvious self-fulfilling prophecies. So they can do whatever they want to imagine is going to resolve the problem, but in reality, there will be enough heads sat there going, "There's nothing we can do." You can't just give up or perceive to give up, because that's political career suicide. But what can we really do? And the answer is nothing, because if you can't kind of deflate this asset bubble without there being serious consequences. You can't keep inflating the asset bubble because there's serious consequences. And that's the whole basis of why this zero QE and zero interest rate policy is impossible. But that's why once you've got it, you're stuck with it. Just ask Japan. I mean, what's Japan going to do? I mean, seriously, allow interest rates to start hiking? No, but in the process, what are they doing by trying to control the yield curve and trying to suppress interest rates and trying to suppress reality? It's going to just blow everything up.
Yeah, and I noticed that the Japanese yen is continuing to sink versus gold, and from hearing what you've just said, I think it's a very good thing. And this is not advice, but to keep a few, as many gold coins and silver coins outside the system and batten down the hatches, and yeah, don't be fooled by what we're told by the central bankers and politicians, and even some people on Wall Street in the city of London. I heard someone commented yesterday in my on the comment section of my video. Oh, Paul Tudor Jones said that the Fed is done a good job, and that inflation is going to come down and rates are going to come down and everything's going to be fine. So, and I replied, I said, well, I don't think Paul Tudor Jones knows what inflation is. He might be a good trader, but in this point, I think he's wrong. So there you go.
Yeah, and I think it's back to this problem where and a lot of this perceptions come about that we've forgotten the historical significance of what inflation is. We've looked since 2008 and gone, well, we have printed all this money and it didn't cause inflation. Well, yes, it did. It's in those asset bubbles. You just contained that inflation in the financialization of assets. So you allowed yourself into this false sense of security that, A, it wasn't a problem when it's an enormous problem because you can't keep inflating those bubbles. But also then, of course, in 2020, when we had the pandemic, it was game over. I said at the time, this is their worst nightmare, I realized, because then all this money didn't just get contained in these asset bubbles, it went into mainstream. And then they kind of went, well, it didn't create inflation last time, so it won't this time. Well, of course it was going to create inflation, and which of course it subsequently did. And now we're in this situation again where they're just trying to sort of conflate ideas that don't marry together. The idea, if they're printing money, it has no consequences. Whether you leave it in asset bubbles in the financial system or it enters the real economy, there are going to be consequences. And that's the problem. They're not seeing those consequences. But it's quite telling, and this just a small point with regards to US bank stocks. And there's this big thing where they go, we need to ban short selling. Well, the reason this has come about is because we've seen this sell off in US bank shares, and it's threatening to push their value below I'm not a big fan of technical thresholds, but this could be an indicator of far more problems for the broader stock market, because we're now at the point where if you look at the S&P 500 financials index, it's on the verge of falling back below its 2007, ironically, peak. And if you look at what happened sort of 2008 Lehman time onwards, it actually took over a decade for that gauge to recover all the ground it lost from the value when it was at peak in 2007. So this is another reason why there's all this fear of, well, if this falls, then that may have a broader problem. And again, this is financialization. It's all about the perception of numbers. Well, what could this do to the banking sector? What's the broader indication for equity markets? So remember, this is all about fictional asset prices. So we need to preserve them. So we need to somehow boost bank stocks back up, so we're not kind of risking falling below this, 2007 high, because that may then precipitate, that these bank stock values fall further, and because the equity prices are falling, then there's more pressures on banks to conserve capital, and we have to cut back on lending. Okay, the argument is a lot of the lending is now in shadow banking, but then that causes problems in the economy, so it therefore creates more of a risk of, is it recession, is it a depression, is it stagflation, what is it? And of course, this is why we have seen banking stocks, not talking the too big to fail, but they have the equity prices have been quite volatile. But these so-called mid-tier banks, where the share price is getting hammered one day to the next, and therefore the question is there going to be any support for these banks and on this basis? And this then leads to back to this scenario of people removing deposits because they're going, hang on, this banks, the share price is just fallen 50% yesterday, or 40% or 30%. There must be a serious problem in the bank. Let's get out. But there's no doubt there are people in Wall Street actually shorting these banks to oblivion, because it's a profitable trade for them. But this, of course, has serious consequences for the broader, financial system, the banking sector. And it's all well and good saying, well, it doesn't affect the too big to fails, but there's not much appetite to bail out banks. Okay, there's bailing out in reality and the illusion of bailing out. But if you keep forcing the bigger banks to hoover up these banks, which JP Morgan has done recently, and it did in the past, around 2008. Look at Bear Stearns, for example. And then the issue is, what are they buying? What are they inheriting? Is this really good for their balance sheet? I mean, given what's the risk of asset impairment on what they've hoovered up as assets from whatever institution that might be, and is this going to be an ongoing problem? This isn't good. People think these are great deals. For me, they're not a great deal for the JP Morgans of this world.
I know. It's like also they said UBS got a good deal buying Credit Suisse. People forget all the derivatives. But just before we wrap up, I just wanted to say as well, Jamie Dimon is wants the government to ban short selling of banks, but I guess he won't ask the government to ban short selling of gold and silver. So there you go. So Paul, thank you very much for your time, and
Oh,
we'll
it's a pleasure, as ever.
keep in touch. And from what you've told us, yeah, things are not as they seem, and there's a lot of illusions out there.
Yeah, and I mean, there's a lot more data you can drill into too. I mean,
Yeah,
this is a bit of a 30,000 foot view because, as you might
yeah,
point out, if we drill in to the data, the risk is you're spending hours and hours doing
yeah.
it.
So just to let you guys know, the viewers, uh, if you want to know more about Paul, you should go to the SiriusReport.com. I think your newsletter, well, you do a podcast almost every day, and you charge about $50 a year, isn't it?
Yeah, you get 1 month free, so it's 475 times 11. I think $52.25 a year if you subscribe for the year,
Yeah,
or it's. I mean, we have got this enhanced service now, which is 550 a month
I
or
see.
pro rata. But that's because we put timestamps in because
Yeah,
people don't have time to listen to everything.
yeah.
But yeah,
And it's
for the
five times a week. You do a,
yeah we do equivalently it's about 5 times 20 minutes. Sometimes we put two together because there's a lot
all
in
right,
one subject. So yeah, it's about an hour. Well, hang on, 100 minutes, 1 hour, 40 minutes a week. But
great.
you don't have to listen to every bit because we've got the timestamps in there
No
to
problem.
help people.
Great, Paul, and have a great rest of the week.
Yes, and you too.
Thank you.